Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to part 2 of my 3-part Roth IRA conversion video series. In this video, we're going to do Roth conversion planning scenarios for 2 major topics. The first topic is going to impact your Roth conversion planning now, meaning in the immediate future. The second topic is going to impact your Roth conversion planning eventually. This topic is about what do you want your beneficiaries to inherit? Do you want them to inherit a traditional IRA or a Roth IRA? And we're going to look at those differences in the second part of this video. For now, let's jump in with the first topic, which is going to be the expiration of the Tax Cuts and Jobs Act on December 31st, 2025. By the way, if you enjoy this video, please like and subscribe and let me know in the comments what other tax topics you'd like to see me make videos about. So, Tax Cuts and Jobs Act expiring on December 31st, 2025. Now, that may sound complicated, but really, it's very simple. Tax Cuts and Jobs Act is just a law. It became the law in 2017, and basically what it did, in a nutshell, what we're going to be looking at in this video is it lowered the tax brackets. So I have the tax brackets down here. Let's do a little comparison between these two charts. So here is the current law, right here on the left side. Here is the law before the Tax Cuts and Jobs Act. That was pre-2018. So up until 2017 ended, this was the law. And this became the law in 2018, and it's going to expire at the end of 2025. So let's just take a quick look here. Actually, what I'm going to do is I'm going to scroll down here to something that's even easier to look at. We're going to take these thresholds right here. This is the tax bracket, the marginal rate. This is the income threshold that you have to be in to be paying at this rate. But we're going to make it a lot easier. I put these thresholds into a chart that's a little bit easier to understand. So here in the green, this is going to be the current law. Here in the red, this is what the law used to be. Now, you're saying, well, okay, but how does this impact my Roth conversion planning? Well, we're going to get to that, but the high-level version is this is the law at which you can do conversions now. But this law is going to expire at the end of 2025 unless Congress does something to extend it. If it expires, the rates will go back to this automatically. Congress doesn't have to take any action at all. This law will expire and the rates will become what they were pre-2018. So you have 23, 24, and 25 to do Roth conversions at the current law. So let's run through this real quick. I have a happy face and I have sad face here to help us out. So under the current law, if you can earn up to $22,000, and this is income from any source, from your salary, from your business, anything, right? This is just the total amount. So you can earn up to $22,000. I'm not going to go through every one of these, but I want you to make sure you understand what we're doing because we're going to use this chart to do our planning scenarios. So under the current law, if you earn up to $22,000, you pay 10%. Previous law, it was $18,650, you pay 10%. These are about the same. Where it starts to change is after you do that. So if you just kind of like start at the bottom and follow your way up. So starting at 0, you start going up, you can earn $22,000 from any source and you pay 10% on that amount. Now between this green line and this green line right here, up to $89,400. Between this line and this line, you're paying 12% on the income between here and here. So between $22,000 and $89,400, you're paying 12%. When this law expires, assuming that it expires and it goes back, the law goes back to this. Now, if you earn up to $75,900 between this red line and this red line right here, you are paying 15%. Okay, so happy face is helping us out here. You're paying 12% right now under the current law from income from any source, including Roth IRA conversions. We're going to get to that in a second. Up to $89,400, 12%. But if the law reverts, if you're doing your IRA conversions, your Roth IRA conversions under this law, when this becomes the law again, unless Congress does something, you're going to be paying 15% on income up to $75,900. That's sad face. Now, the next bracket between $89,400 and $190,750, between this line and this line, you're paying 22%. That's happy face. Between this red line and only this red line right here, $153,100, you're paying 28% on income between these two lines right here. That is sad face, okay? And finally, it does go up higher than this, but for this video, we're just going to stick to one more. Between $190,750 and $364,200, you are paying 24%. That is happy face. But if you're doing your conversions when the law changes back to this, between $153,100 and $233,350, you are paying 33%. That is sad face. So based on this chart, if you understand how as you move up, you keep increasing the bracket, we're going to now look at how you use this to do your Roth IRA conversion planning. Okay, so let's go down here. As I said, this is very important to understand. Tax Cuts and Jobs Act is going to sunset. They call it sunset. That just means expire at the end of 2025 unless Congress does something, and that means that the tax rates will go back to the pre-2018 rates. So you have 3 years. In fact, let's go down to this timeline. Let's take a look at this timeline and see what's going on. This is not a political channel, but inevitably politics and tax rates are intertwined. So we need to, at a minimum, take a look at the political timeline of what is going on over the next couple of years. So right now, this video is being made in November of 2023. So if you're watching this video in 2023, you have some time to do a Roth IRA conversion here at current rates. You have time to do it in 2024. And remember, if you watched video 1, typically you don't want to do a full conversion because what you're doing, if we go back up here, you're going to probably be pushing yourself up into these higher and higher rates. What you want to do is you want to try to fill up your bracket. So let's say you have income and it's just like it's right here. Well, you could do a Roth conversion to fill up your bracket to this line and still only pay 12% on the conversion. If your income is up here, you could do a Roth conversion up to this amount right here and fill up your 22% bracket and try to get your income converted into a Roth at the lowest rates possible. And we're going to do an example of that in a second. But let's go back to the timeline, because we now have 3 years basically where current law is in effect. So here's when the video is being made. Now, what is happening in 2024? Well, first off, between 2023 and November 5th, 2024, which is election day in the United States, between this yellow arrow and this yellow arrow right here, we have a split Congress. Okay? And it's also an election year, 2024. Do you think that any major tax legislation is going to be passed before Election Day 2024? Probably not. In my opinion, that's highly unlikely that we're going to see any change in the tax law between here and here. Okay? So you clearly have 2023, 2024 to do Roth conversions under the current law, under current rates. Now, the law is still in effect in 2025. It expires right here. Tax Cuts and Jobs Act will expire right here automatically unless Congress extends the law or changes the law to something else to replace Tax Cuts and Jobs Act. Okay, will the Tax Cuts and Jobs Act be extended or alternative tax legislation passed before 12/31/2025? Nobody knows the answer to that. Okay, anybody who tells you they know what's going to happen after Election Day 2024 is making it up. They have no idea what's going to happen between here and what's going to happen after the Tax Cuts and Jobs Act expires right here. Will Congress extend Tax Cuts and Jobs Act? I don't know. Nobody knows that. Will they pass alternative tax legislation? I don't know. What if we get another split Congress, right? Like approximately half of Congress people will be up for election on this day as well. So Congress is going to shift. If we end up with a split Congress between here and here, how likely is it that major tax legislation is going to be passed? That's anybody's guess. My opinion would be that's pretty unlikely. If you have a split Congress after Election Day, that split Congress will go out for 2 years, right? So it'll pass this expiration date of the current tax law. So if Congress is split and they just can't get tax legislation passed, or they can't agree to extend the Tax Cuts and Jobs Act, this will go away and we will be right back here automatically. They don't have to do a single thing. We will be right back here at these higher rates, at these sad face rates, and you'll be wishing you did some Roth conversion now under the current law, because you can get much more preferential rates now. You can convert and get your income up to $190,750 and still only be in the 22% tax bracket. If the law changes back to this, $153,100, you'll already be in the 28%. In fact, you'll be in 28% as soon as you cross $75,900. So you're going to be much more expensive to do Roth conversions over here than it's going to be to do them over here. So let's go back to the timeline. So we've covered this. Basically, what the question is from the what is the question you need to ask yourself from a Roth IRA conversion perspective, looking at this timeline, knowing that this is an election year, probably going to be a tumultuous year by all accounts. Who knows who the president's going to become on this day? Who knows who's going to control Congress on this day? What do you have to ask yourself from the perspective of doing Roth IRA conversions? Well, can you predict the future? No, nobody can predict the future. But what you can do is you can ask yourself this: based on your personal financial, your personal income situation, your career status, your retirement plans, your age, your cash flow needs, et cetera, do you want to lock in some Roth conversion now at rates that are known? Do you want to lock in some Roth conversion over 2023, 2024, 2025 at rates that are known, right? The law is known. You can calculate what the tax effect of your conversion is going to be at known rates. Or do you want to wait and see what happens after Election Day 2024? I mean, if you get one party controlling the presidency and both houses of Congress, certainly the law could change. Which way it changes, that's going to be anybody's guess. So we're going to look in a moment about where tax rates are now versus from a historical perspective, because actually they're pretty low right now from a historical perspective. So we're gonna ask ourselves, based on the history of tax rates, based on we have the annual budget deficits, the national debt of the United States is growing every day. Do we really think that tax rates are going to come down, considering that they are at historical lows? And I'm going to show you that chart in a minute. But before we get to that, let's do an example of the difference between doing Roth conversions at current law and doing Roth conversions at the law that will become the law at the end of 2025 if Congress doesn't do anything. So let's go over here. I have a little arrow here, which I'm going to borrow. I'm going to bring that over here. Let's just say that for this example, your income is going to be right here at 150. Okay, that's about 150. So you're in the 22% tax bracket right now with a salary of 150. Okay, so let's go over here to the calculation and see what we got. All right, here is two scenarios. Here's your annual salary. We're just going to assume that's 150 every year. It's just going to be constant for this example. We're going to do 3 years of Roth conversion for 2023, 2024, 2025 under current rates. Then we're going to assume that you just waited. You decided not to do any Roth conversion now. You're going to wait, and the law expires. The rates go back to the old rates, and you're going to do 3 years of Roth conversion between 2026 and 2028, assuming that the Tax Cuts and Jobs Act expires and it's not replaced by anything else except the old law. All right, so very simple example. Here's your annual salary, 150, 150. That puts you in the 22% bracket. Okay. Roth conversion. Now what we're going to do is we're going to, right here in this cell, okay, what do I have here? 190,750 minus 150, minus the amount in this cell right here, okay? That's 40,750. And what is the relevance of this number again? What is the relevance of 197.50? That is the top of the bracket. Let's go back over here. Here's the top of the 22% bracket. Remember, you're here already. Your annual salary already puts you right here at 150. But you have room. The top of this bracket is at 197.50. So you can pick up more income and still have it only be taxed at 22%. You're not going to go up into the higher rates yet. So the difference between 197.50 and your salary of 150, which I have right here, is 40,750. That's the relevance of this number minus 150. Okay, so you do the so this is the additional income that you can pick up, additional taxable income that you will pick up by doing a Roth conversion. And let's say that you're at the 22% rate, right? So the tax on this conversion is 40,750 times the 22% rate gives you 8,965. This is how much tax you're going to pay on the conversion. And if we multiply that by 3 years, doing it 23, 24, 25, that's going to be 26,895. So again, this is just the additional income pickup from the Roth conversion times 22% is what's in this cell right here. And then this is just multiplying that by 3. 26,895 of tax will be paid if you do Roth conversions of 40,750 for 3 years in a row under this scenario. Now, over here, let's say, are you still earning 150? Okay, we're just going to keep the math simple. If you do the same conversion, now this doesn't fill up the bracket, but what I want you to see is I want you to see an identical conversion, an identical amount being converted. Okay, under the old rates, let's go back. Let's see where 150 is under the old rates real quick. 150 is right here, actually. It's right under 153. Okay, so to make the math simple, I'm not going to worry about the extra $3,000 that's still in this 28% bracket. We're just going to assume most of it, the majority of it, is going to be above this red line. It's going to be at 33%. Okay, let's make the math easy so we can understand. Right, the actual answer, there'll be a few $1,000s taxed at 28%. But to make the math easy, we're going to just say it's all taxed at 33%. So the tax on conversion is going to be 40,750 times 33% is 13,448. Okay? That's just this number times this number. We're going to multiply that by 3 for 3 years. Gives you 40,343. So the difference between this 13,448 and this 8,965, that's just the difference between those two numbers. This is an additional $4,400, let's say $4,500 of tax each year. Additional tax by doing your conversions at these higher rates versus under current law. Over 3 years, that will add up to $13,448. Okay, so let's just say $12,000 to $13,000 because there was a little bit that was in the slightly lower rate. So whatever, $13,000. The point is not the exact number; it's the concept. You will be paying $13,000 more into the government by doing 3 years of conversion. If the law expires, it goes back to the old rates, versus doing some of your conversion now at rates that are known. You're putting an extra $13,000 in the government's pocket out of your pocket on the same conversion. What matters is what the rate is. What is the law? That's why you might consider doing some Roth conversion now at rates that are known. Now, but what if rates go down after 2025? Well, if rates go down after 2025, then you wouldn't want to do Roth conversion now, right? You want to do Roth conversion when rates are low, not when rates are high. So if rates were to go down, then you would want to hold off. You would want to wait. But do you know if rates are going to go down? No, you don't know that. You don't know what's going to happen after the election. at the end of 2024. We're going to look at some historic tax rates in the United States to see where we are relative to that. By the way, before we go there, let's go back here real quick and just take a look. What is the top rate right now? 37%. If you make about over 700,000, you're in the 37% tax rate. That's the highest rate right now. So keep that number in mind, 37%. Let's go down here. We're going to go all the way down to a chart that I have on historical tax rates. Here we go. This chart goes from 1951 all the way to 2002. And you'll see in 2002, the top rate, the number on the left side of this slash is the lowest rate in that particular year. The number on the right side is the highest rate. Now look at this, 91% was the highest rate between 1951 and 1963. I mean, that's ridiculous. 14%, 70% between 1964 and 1981. Now, this chart only goes up to 2002, but the 39.6, a lot of people will recognize this number. This 39.6 top marginal tax rate, this was the law from 2002 all the way up to the Tax Cuts and Jobs Act in 2017. So basically, from 1951 all the way up to 2017, let's look at what the top rate was. 91%, 70%, 50%. Let's skip these two lines for 1 second. 39.6, 39.6, 39.6, all the way up to 2017. This 1988 to 1990, 1991 to 92, this is 4 years. There was 4 years of time when the top rate was less than the current rate of 37%. 4 years from 1951 to 2017. Okay? I have that right here. Between 1951 and 2017, there were only 4 years when the top marginal tax rate was lower than it is today. Okay, so when you're thinking about, should I do some Roth conversion now at rates that are known, the law is known, the law is in place, 2023, 2024, 2025, should I do some Roth conversion now at historically low rates, or should I just wait till after the election on November 5th, 2024 and see what happens? If, let's say that Republicans control the presidency and both houses of Congress, is it possible that the marginal tax rates will come down? I mean, I guess it's possible. I'm not saying it's impossible. It certainly could happen. But historically, since 1951, there's only been 4 years when rates are lower than they are now. So most people that I talk to don't think rates are going to get much lower. I'm not saying it's impossible. I'm not saying it couldn't happen. Nobody knows what's going to happen after the election in 2024. But historically, if you're just looking from a historical perspective, rates are pretty low relative to where they've been from 1951 to 2017. So, a lot of people are saying, well, rates are pretty low. There's 3 years left before the Tax Cuts and Jobs Act expires. Maybe you should consider doing some Roth conversion. Now, and the beauty of doing partials, remember, let's go back up here real quick. Remember from video 1, I said, it's usually better not to do a complete Roth conversion. You don't need to convert your entire traditional IRA into a Roth IRA in 1 year. In fact, that'll push you up higher in the brackets, which you don't want. What you want to do is a partial. Figure out how much more income can you pick up to fill up whatever bracket you're in, and decide, is that the appropriate thing? Should I, like in this example, this person can convert $40,000 a year at 22%. The reason that I say partial is helpful, especially considering the unknowns of what's coming after the election and the expiration of the Tax Cuts and Jobs Act, look at it this way. If you do a partial now, so you do 3 partials, 2023, 2024, 2025, if rates go up, you're going to be happy that you did them. On the other hand, if rates go down, but you only did a partial, you're going to be like, it would have been better if I could have predicted the future. It would have been better not to do any. But at least I didn't do my whole portfolio, right? I just, I did a little bit. I did 10, 20, 30, 40,000 bucks. I got a little bit of benefit from these, what I thought were the lowest rates. Rates actually went down more. I mean, let's just say that happens. And then you could potentially do the rest. So if by doing a partial, you kind of can sort of win both ways. It's like, if rates go up, you're going to be happy you did some in 2023, 2024, 2025. If rates go down, you're going to be like, well, at least I didn't do the bulk of my portfolio. I just did a little bit, considering that at the time, nobody knew what the rates were going to be in after the Tax Cuts and Jobs Act expired. And that's going to bring us to the second topic of our video, which is, this is the one that I said would impact your Roth conversion planning eventually. And that is, what do you want your beneficiaries to inherit when you ultimately pass? Okay? Now, let me preface this section by saying two things. Number one, I understand that tax planning regarding your ultimate demise is not something a lot of people like to talk about. Okay? But tax accountants get used to talking about it because these things often go hand in hand. And you want to make sure that your kids, or whoever your beneficiaries are, they get the most, and the government gets the least of their inheritance. Okay, so it's just a necessary evil. It's just something we got to talk about when we're doing tax planning. Number two that I want to preface this with, you should be aware that there is a whole world of estate planning, trust planning out there. If you believe that such planning would be appropriate for your family's situation, you should seek out a competent estate planning attorney to help you set up those estate and trust structures. Okay, this is a whole world in and of itself. If you have significant assets, enough to make it worth doing this, you should seek out an estate planning attorney to help you do that. That would be my recommendation to you. What we're going to look at for this video is we're simply going to talk about the difference between your beneficiaries inheriting a traditional IRA versus a Roth IRA. You could have $500,000 in a traditional IRA, and it may not be enough to really go through the expense and effort of setting up these estate and trust planning structures. You got to be pretty high net worth usually to make it worthwhile. A lot of estate planning attorneys will offer you a free consultation. I recommend, if you think it might be worth it, just give them a call. Have a free consultation about your specific facts and circumstances and see if estate and trust planning is right for you. If you don't have any of these special trust vehicles and stuff set up, then this could apply to you right here, which is what we're going to talk about. Your beneficiaries simply inherit a traditional IRA, or they inherit a Roth IRA, or they inherit both if you have both. And this is particularly relevant because if you're watching this video, you probably have both a traditional IRA and a Roth IRA, or you're planning to open a Roth IRA and do Roth conversions from your traditional IRA. So it's certainly possible that you have both or could have both. And in fact, by the way, I do have a video explaining in detail the major differences between a traditional IRA and a Roth IRA, and actually why you should have both. So including some topics that a lot of people don't really realize about these two tax-advantaged investment vehicles. If you're interested in knowing more about that and ideally why you should have both, there is a link to that particular video in the description below this video. With that said, let's jump into the difference between inheriting these two different types of tax-advantaged investment vehicles. So, if your beneficiaries inherit a traditional IRA, they will be required, okay? That's very important. They will be required to withdraw the money within 10 years, and it will be taxed at whatever their marginal rate is. We're going to do an example to see what's going on here with this in a second, okay? But they're not going to be able to defer this. It's going to be required to be withdrawn from the traditional IRA. If they inherit a Roth IRA, they will still be required to withdraw the money within 10 years, but it won't be taxed. Just like once you get the money into a Roth, that's it for taxation. You get what's there. There is no more tax once you get it into a Roth. And you have to meet some basic rules like 5-year holding period and stuff. But in general, like as long as you meet the basic rules, there's no tax. You will not pay tax when you pull the money out of a Roth. Your beneficiaries will not pay tax when they pull the money out of an inherited Roth. So the difference is if they inherit this, they're going to be taxed and they're going to be forced to take the money out. If you want to learn more about the rules that require inherited IRAs, both traditional and Roth, that requires the money to be withdrawn over 10 years, you can learn more about that topic by Googling the Secure Act. Sometimes it's called the Secure Act 1.0 and Secure Act 2.0. Secure Act and inherited IRAs. You can Google this and you can learn all about the new rules that require the money to be pulled out of these over 10 years. Okay? So knowing that, what should we consider with respect to Roth IRA conversions from a planning perspective? Let's go down here. Here's the tax rates again, right here in this chart. Let's put aside the issue we discussed a minute ago about the tax rates changing and the laws changing, et cetera, et cetera. Let's just assume that these rates remain the law for the foreseeable future to make the math simple, okay? We're going to assume that this is the current law, okay, under Tax Cuts and Jobs Act. We're just going to assume this remains the law for purposes of this example. We're not going to complicate it with law changes, okay? So let's go down and do this example. Here is your daughter, Jane. Jane is a hard worker. She's a college graduate. She and her husband combined bring in $250,000 each year in salary. They file a married filing joint return. That puts them in the 24% marginal tax bracket, okay? Now, you, on the other hand, you are in your retirement years. You have a nice nest egg of $500,000 sitting in a traditional IRA. But you live modestly on an annual income of $50,000 per year, and that puts you in the 12% marginal bracket. Okay, so these are the facts of this simple scenario. All right. Now, under this simple scenario, okay, if you were to pass and Jane inherited $500,000 in the form of a traditional IRA, right, she would be forced under the Secure Act 1.0 and 2.0 to withdraw the money over 10 years, and assuming that she and her husband remain in the 24% bracket due to salary, they have stable jobs, let's just assume for this example that they're in this bracket the whole time, she would pay 24% on the withdrawals, at least 24%. It's possible the withdrawal will kick her up into the next highest tax bracket. That's always possible, especially because she's being required under Secure Act 1.0 and 2.0 to take the money out. She can't defer it. She can't delay it. She's going to have to take the money out. Let's just say that it all falls within the 24% tax bracket. It doesn't bump her up into the next tax bracket. We're going to keep it simple. So if she's already in the 24% tax bracket due to salary, she gets more income. So the total tax paid on the inherited IRA is going to be $500,000 over 10 years. She's in the 24% bracket. $120,000 of tax will be paid as she's required to take this money out of the traditional. Okay? Now, let's look at an alternative. Alternatively, you take a look at your bracket and you see that the top of your bracket is $89,450. Let me scroll back up here to the brackets real quick. So you're here. You have an annual income in retirement of $50,000. You're in this bracket right here. You see that the top of the bracket is $89,450. Okay, so we know that. So let's go back to the example. You see that the top of your bracket is $89,450. You have an annual income of $50,000. That means that you have $39,450 of extra room that you can use to max out your bracket and still have that Roth conversion taxed at 12%. So you decide to do Roth conversions of $39,450 for each of the next 10 years, okay? And then you pass with Jane inheriting both your Roth IRA that you're creating by doing these conversions and whatever's left in the traditional IRA. Okay, we're keeping the math simple, right? You continuously earn $50,000 a year. You're going to continuously do this conversion for 10 years. Okay, so Here's your annual Roth conversion, $39,450. We do that for 10 years. The total conversion is going to be $394,500. You're in the 12% marginal rate. So the tax that you pay on the conversion over this 10 years will be $47,340. Okay? Now, you pass, Jane inherits both your Roth and your what's left in your traditional. So Jane will inherit this. This is the amount sitting in the Roth, and this is tax-free. So she'll be able to get this money. She'll be forced to take it out over 10 years, but it'll be tax-free. On the other hand, there is $105,500 still sitting in the inherited traditional IRA. Okay, this is just $500,000 minus this number right here. Okay, this is what's sitting in the traditional IRA. She takes this money out because of Secure Act 1.0 and 2.0 at 24%. Okay, she pays $25,320 on this. So if I take the $47,340 that was paid in tax by you doing the Roth conversions, plus the $25,320 in tax that she will have to pay at her marginal rate on the rest of the money that's sitting in the traditional, the total tax paid, if you add this and this, you get $72,660 of tax paid. So let's compare the two scenarios. Okay? Scenario one was $120,000 paid at Jane's marginal rate in scenario one, because the entire thing was taken out of a traditional. She inherited the full amount in a traditional. Scenario two was $72,660 when you did Roth conversions while you were still alive, before she inherited the Roth. You paid tax of $47,340. She paid tax at her marginal rate on the remaining amount. Total amount $72,660. The difference $47,340 just from doing some simple tax planning. That is 50 grand. $50,000 more cash in Jane's pocket. I mean, that right there could put one of your grandkids through college, as opposed to just handing the money over to the government. As you can see, some small tax planning can potentially go a long way to protecting your family's future and your financial well-being. It's just a matter of looking at your tax brackets, being like, okay, Jane is a high earner. She's up here in the 24% bracket with her husband. You're down here right now in retirement. If you start doing Roth conversions and maxing out your bracket here, your family in total can pay a lot less in tax than having Jane deal with all of the tax in this bracket after she inherits the retirement accounts. Okay, so that is a simple example of how, if you start considering your beneficiaries and what you want them to inherit, remember that if they inherit a traditional IRA, they're going to be taxed on that money that comes out. There's no penalty. There's no 10% withdrawal penalty on inherited IRAs, but they're still going to be taxed on a traditional. All right, and Roth IRA, no tax. So it could be beneficial to your family as a whole to start doing some Roth conversions now, especially if you're in a lower rate in your retirement years. If you enjoyed this video, please like and subscribe, and let me know in the comments what's going on in your financial planning situation. And if there's enough interest in a topic, I can certainly make some additional videos about that. Also, make sure to watch for part 3 of this video series, where I am going to show you how to really hone in on your specific facts and circumstances for Roth conversion planning. In part 3, we're going to actually start plugging in numbers into TurboTax, because TurboTax will be able to handle a lot more complicated scenarios than these simplified scenarios that I am showing you in this video. And I'll show you how you could use TurboTax as a tax planning tool for yourself instead of just using it simply to file your tax return. Thank you for watching, and I will see you next time.